For those that don't know Mercia Asset Management, we're a domestic proactive specialist asset manager with a strong focus on UK regional businesses that are seeking debt, private equity, and venture finance. And just to remind those of our business model, we have over 700 million in assets under management, and a vast majority of that are in third-party funds under management. We support businesses with those third-party funds selectively before we bring businesses across onto our balance sheet. The balance sheet, which is a debt-free, cash-rich balance sheet, is a selective investor in those managed funds, as well as investing and scaling businesses that come out of those managed funds. And the business model that Mercia has developed over many, many years, actually, is predicated on the cyclical nature of private capital deployment, where we find that returns are optimized through really investing through the cycle. So that's in the upswing, in the good times, and indeed through the bad times. And that really is dependent on being a cash-rich organization with preserved capabilities to do this. The regions are a really important thing for Mercia. And the reason why the regions have always been important to us is twofold. The first thing is that typically the businesses there they have very modest capital needs. Most of our businesses, we have about 400 businesses across our various asset classes. They have typically less than 20 million. So 10 to 20 million is their total capital needs. And the other important point is that capital has a habit of concentrating on the capital into London. And that lack of capital in the regions means that there is sensible pricing opportunities. And we combine deep venture, deep investment experience with operational experience. We take board seats on pretty much all of our equity deals. And through our investment capacity, we take 10 to 30% equity stakes. I think importantly, just to set the real scene for this presentation, if you like, was in December 2019, we acquired 3 VCT fund management contracts from MVM Private Equity. And we'll refer to those as the Northern VCTs. I'll refer to those as the Northern VCTs throughout. On the 3rd of April, we made an announcement that those VCTs raised just over 38 million, which is an exceptional performance in the current climate. And that means that of that sort of circa 700 million we have under management, something like 260 million of that is in unrestricted cash across those asset classes I talked about that we invest in. 30 million of which is on our balance sheet and 230 million on our funds under management. So a very liquid group as well. So I would pull out really 3 themes that Mercia is focused on. The first one is about being operationally prepared. So for years, Mercia's got 8 offices across the UK with about 100 employees. And we've done an awful lot of remote working. Tools such as Slack, tools such as Zoom are things we've used for years. So we have slotted in quite quickly into this remote operations that we all find ourselves in today. And I've been super impressed, really impressed by the team and their resilience and capability to switch so quickly to remote working, and importantly to support our portfolio companies and indeed to stay connected and reassuring to our fund investors who are critical in our ongoing operation. The second one, which I've really already alluded to, is the importance when it comes to investing through cycles, which is that you must have the cash to make decisions, to give you options. And we are very financially secure. 260 million is an enviable position to be in, with free cash to invest across the group, to support existing businesses. And importantly, we are still open for business. We are still making new investments. And the third one, which I'm afraid, Mercia is not immune to the current environment, and that we will be impacted. Our revenue will be impacted by the current environment at the moment. But this is very much near term, and we expect our medium and long term position to be strong as we come out of this. We have a strong cash position, as I've already mentioned, at Mercia. And we have a long-term perspective in terms of the investment capacity that we do. And actually, these sort of market dislocations, where there is a correction downwards, are very good for us. And that's back to my point about the fact that we are still making investments. Venture in particular makes its money, unfortunately, through the downswings, not the upswings, not investing on the top of the market when you're investing in a business that might be worth this value, but investing at the real price that that business is worth. So we are well placed in that regard, and our investment approach and strategy is unchanged. It's also important to note the types of funds that we manage, which when we talk to interested parties in Mercia in our operation is that our funds are predominantly private. They are private funds, typically 10-year funds. These are funds where the capital, if you like, is captured. It's fixed capital within them, as is with our evergreen funds as well. So that cash is there to deploy over time and is very difficult to be returned back to the original providers of it. And that's really important because that also preserves the income for the management business. So our management fee income is predominantly preserved as well as we go through this. And I think that's really important. My final point, actually, in terms of not changing, is it's important to what I would call preserve capability. We've built a very good team within Mercia, and during these difficult times, that good team really starts to shine through. Having capital under management, having the free cash, and having in preserved fee income means we can preserve capital to make the right decisions for our existing portfolio and make new investments too. This is the third cycle that I've invested through. So I've experienced 2000, experienced 2008. And when the public market corrections happen, there is an inevitable sort of 3 to 6 month lag where the private community corrections actually happen as well. And so you've seen 25, 30% being taken off the public markets, and I would expect that to flow through into the venture markets. And that was shown in the recent business update that we provided. And in that business update, we talked about the VCT funds and their revaluations against their NAV, and there was a circa 22% discount against the original holding values. And we expect that to be quite an industry, broadly an industry sort of reaction as well. So yes, we do expect these things to go through. It's back to the earlier points that I was saying before. Your entry prices are then, there's a light shone on your entry prices. So if you've paid well and you've bought well to get into these businesses, then the corrections you experience will be modest. If you bought the valuation of a number of years ahead of when you go into it, those corrections will be markedly more. And that happened in 2008 and it happened in 2000, where actually some VCs, they had discounts of 40, 50, 60, 70% of their portfolios. We don't expect that. We've bought well with our businesses, but we do expect that read through that the VCTs have shown to come across more broadly. So broadly, this time last year, we set our stall out for our 3-year target. So this is prior to COVID-19, prior to quarter of the planet being locked down. And those were 3 targets, which were grow assets under management. We had about $500 million in terms of AUM when we made that statement, and grow that to $1 billion. To take the group to a profitable trading position within the 3 years, so to our financial year 22, and to evergreen the balance sheet. And if I look at those today, they are still achievable in that time limit. So even though our revenues have been impacted in the near term, those three targets are still eminently achievable. And as I speak today, we have over 700 million in terms of assets under management. So we're on that journey to the $1 billion. We're on that journey to profitable trading. And we hope and we will be on that journey to evergreening the balance sheet over the medium to long term. So as with all cycles, no matter what their trigger is, COVID-19, financial correction, etc., there are winners and losers. There are always winners and losers. And the sectors that we think are interesting in terms of, if you like, on the winners front, are things like the software SaaS business models, where you've got recurring revenue coming through, you've got contracts that are baked in. We think that's really attractive, and a lot of our portfolio actually are SaaS software businesses. Biotech and healthcare, for the obvious reason, that agenda has been risen up very high, and we expect further investment into that arena as well. And then I think, ironically, with quarter of the planet at home, looking for entertainment and things to do, digital entertainment is really coming into its own. And I'll talk about a few of those things in a moment. But I think it's important to know, I mean, we made an announcement on the 2nd of April about 2 of our portfolio companies that are held in our funds and on our balance sheet, Native Antigen Company, NAC, and Oxgene. Now, Native Antigen Company produces native antigens, as its name implies, which are derived from bacteria and viruses. Now, the antigens are proteins. They are products that so in your immune system, you have antibodies that react to antigens. And in the press at the moment, there's a lot of talk about an antibody and antigen kit in development, for instance. Oxgene is a synthetic biology business. Now, Native Antigen Company was one of the first, if not the first, companies to bring COVID-19 antigens to the market. and it is inundated on a global basis. So it is growing quickly in that regard. And it was a business that was already rapidly scaling, but it is working hard to meet a global demand. And that global demand is for the supply of antibodies to these, supply of antigens to these antibody kits, these diagnostic kits, for vaccines, because antigens are what the basis of vaccines are. So supplying antigens to vaccine development and research, and then of course just general research agents in this arena of COVID-19. Coincidentally, Oxgene at the end of 2019 developed an amazing system for amplifying and scaling protein production. So antigens are proteins. So if you bring those two companies together, we believe together that they can really meet the challenges and opportunities that COVID-19 has thrown up in terms of meeting what is a tremendous global need, and therefore a tremendous need to supply COVID-19 antigens. So that, I think, is a great success story. We had two businesses growing rapidly anyway and bringing them together to meet the current challenge, and we're very confident they will do that. But then above and beyond NAC and Oxgene, in terms of, as I said, back to our model and the funds and then onto the balance sheet, we have a number of other businesses that are on the balance sheet and, of course, came through our funds originally. We talk about digital entertainment. So Soccer Manager, which is a football management game, is absolutely booming at the moment. So a lot of people playing that game. That is a business that's really performing very well in this environment. And they're very sticky. So once people start playing these games, they remain on them. So this captive audience is fabulous for it. Another business that I think is worth noting is a business called Intechnica, and it has a product called Netacea. Now, Netacea has a sort of bot detection and actually queue management system. And a lot of people are online at the moment, online shopping going on, but also, of course, the grocery deliveries. And they're working at the moment with Ocado and a virtual rooms and a queue management basis. So that, again, Netacea is really coming into its own at the moment in this environment. And another business I'd like to mention is Zen Dreams. And Zen Dreams develops content, its own proprietary content, as well as for others, for virtual reality, for VR. Now, it's got a game called Phantom, which originally it was going to be, and it's done this with Oculus, with Facebook. It was going to be bringing that out in December this year for the Christmas market. But because of demand, the Oculus headsets are all sold out. So there is a huge demand now for content. And because of that content demand, they've brought that game forward now into June this year, and that will be launching. So again, another business that's really prospering from a captive audience, I'm afraid to say. And then there are businesses that are younger that are within our funds, so yet to come onto the balance sheet. Business called Sense Biodetection. So back to what's in the news at the moment, it's about detecting viral infection firstly, and then detecting those that have had the virus and are looking at antibody detection. So NAC is looking at the antibody development using lateral flow diagnostics there. And Sense Biodetection has got a point of care rapid diagnostic that it uses to look for viral load. Now, it's been doing this with other viruses, and now it's switched its development efforts, which is now being funded, to looking at the COVID-19 challenge. Another business is Abingdon Healthcare, again in the news, talks about these antibody tests coming through in the diagnostics where they're failing, and they're failing because they're faulty and they're being returned back to the overseas developers. So there's an increased demand now for good quality diagnostic kits to be prepared for third parties and obviously released into the system. And Abingdon Healthcare is exactly that. And so it's had an unprecedented level of demand as well, and a business that's starting to prosper as well. And I guess just really bringing all of this to an end, I think the one thing that's important in all this sort of doom and gloom out there is that, we do see a sort of light at the end of the tunnel. And the one thing that, we are very certain of is this current healthcare dilemma will end. And when it ends, it's all about actually having solid and secure footing, both in terms of Mercia as an asset manager, but also in terms of its own portfolio to support going forwards. And as I said at the very beginning, and we are making new investments. So we are an active manager that will continue to supply capital on a regional basis to these businesses that deserve it and will flourish afterwards with it.